Welcome back. Today we're talking about introducing the business model and what it entails, all the component pieces of it, and what you can do to figure out how your whole business will work all together. So these are the components of the business model. We're going to go through them one by one. First of all, let's start with revenue. Revenue is the money that you earn from operating your business. So it would include any money that comes into your business as a result of providing goods and services, but it would not include money that comes in from other sources, like interest from investing in the stock market or any other kind of investment, or money that's coming in from investors in your firm. So revenue is money that you are earning. And there are a lot of questions that are relevant to the revenue model concerning who will buy, how often, how soon, those kinds of things. So keep that in mind when you're thinking about revenue. It's money that you're earning. The next piece is gross margin. This is basically how much money of that revenue you're going to be able to keep after paying the direct costs of what was sold. So we'll get into margins and how they work in the next section, but keep that in mind. This is the money that you get to keep after paying the direct costs of what was sold. The next piece is the operating model. These are all the other costs that it will take to run your business and make sure that you can provide the goods and services that you need to sell and generate that revenue. But they're not related to direct costs of producing those goods and services. So these would include things like your rent for your office space, salaries for full-time employees, and other things like that. Working capital is the next important piece. This has to do with the flow of money in and out of your business. It has to do with timing. When do customers pay you, and when do you have to pay your suppliers? This is also referred to as cash flow. Lots of times when you're thinking about businesses, you think about cash flow. So examples of this we'll get into more later. But the bottom line is you need to be thinking about the timing of when you get paid and when you need to pay. The next is the investment model. Some businesses, many businesses, need capital to get started or to launch a new initiative or a new program. So, for example, if you have a business that relies upon a warehouse, you might need to invest in that warehouse up front before you can begin operations. Or if you're trying to make some penetration into the market and gain market share, you may need to invest money in an advertising campaign. If this is money that's coming from the outside, from your pocket, any place that's not part of the revenue model, it's probably an investment. And you have to think about that and what it will cost you, what form it will come in, and how long you think it'll take before you expect to break even on that investment. Break even and profitability are another important point. We just talked about investments and when you might think about paying back those investments. Breaking even on an investment of, say, $1,000 into your business for an advertising campaign is an important thing to know if investors want to see when they might get a return on the investment they've put into your company. At the very least, they'll want to know when they can know this was a good idea to put the money into the business. The other way to think about profitability is the profitability of just day-to-day operation. So when you look at your revenue coming in, you subtract the cost of goods sold from that to see how much money it has cost to produce those revenues. And then you look at all of the operating costs and you total all that up. At the end of the day, does it make sense for you to have a business, to have it running, and to show up and turn on the lights every day and start working? That's a question of profitability. The last two pieces to consider are the cost of customer acquisition and the lifetime value of a customer. This is simply a question of how much will it cost for us to get customers to learn about our company, what we're doing, become interested and engaged, make a decision to purchase. How much will all of that cost? And if we acquire someone as a customer, how much money can we expect to make from them over the entire time that we will have contact with them, the entire lifetime of that customer? If you think about an example like Netflix, Netflix is always thinking about how much money it costs them to get a new subscriber, but they also think about how long will people stick around? How many months does a person typically stay with a Netflix subscription and keep paying? These numbers have to make sense. The cost of customer acquisition can't be higher than the lifetime value of a customer, or your business won't last very long. So in review, here are all the components of the business model. The revenue. How is money coming into your business as a result of operating and producing goods and services? The gross margin. What are the direct costs associated with generating those goods and services? The operating model. What other costs do you have besides producing those goods and services, but things that are essential to support it? The working capital model. What is the timing of money coming in and going out of your business? The investment model. What outside money do you need to get something going or to start a new initiative? The break-even point and profitability. When would any investments be paid off? And at what point does it make sense for you to operate a business day to day, week to week, and month to month? And finally, the cost of customer acquisition and lifetime value of a customer. What does it cost to get new customers to buy your products or services? And how much money do you expect to make from them over time? These are the basic, universal components of a business model that we'll cover in this class. Think about these and how they might apply to your business. Talk to you next time.